So the old traditional guarantor, someone just sort of vouches for you and says that they'll pay the mortgage if you can't. That kind of has disappeared really, and it's moved over to something that they call joint borrower sole proprietor. So not available for every lender. So there's only certain lenders who will look at it. But basically, how it works is, generally speaking, it'd be a parent, but it can be brother, sister, auntie, uncle. They would go on the mortgage with the buyer, and effectively their income would be used towards affordability, but only the buyer would be named on the deeds.
Okay.
So 2 people, or even 3 or 4 people on the mortgage, 1 person on the deeds, and the big difference there is that gets around stamp duty. So
yes.
mum or dad or whoever it is doesn't have to pay the additional stamp duty. The only, you do need to take independent legal advice when you're doing something like that, because mum, dad, auntie, uncle are then in a position where they're responsible for the mortgage but don't have any sort of control over the security.
And does the guarantor have to inform any other lenders that they may have borrowing with?
Yeah. So if mum and dad, so all their circumstances have to be taken into account. So if they've got mortgages in the background, they'll also all have to be factored in. And then, as you rightly say, if they go on to try and apply for a mortgage in the future, they'll also have to take the mortgage into account. And it's the full mortgage, not just their portion.
Their proportion.
Yeah.
So something that I think we both come across in the agency world and in our personal lives have been people have asked us questions on, I missed a mobile phone payment when I was 21 and I'm now thinking of buying my first house. They think they're blacklisted, they're never going to get a mortgage. Is that a misconception or is that reality?
The short answer is no, it's not, but it does depend on the situation. So one common thing that we see, and it seems to have been happening more over the last few years, a utility provider's been pretty quick to slap a default on someone.
Right.
So we'll see, I'm not going to name names actually. Someone's maybe had a very, very small payment on the account, they've forgotten to cancel it, not realised, moved house, whatever it might be, and the next thing you know, they've got a default for 25 quid, which seems innocuous and is innocuous, but can cause real issues. For some lenders, that is literally just going to be no, I'm not interested, you're going to have to wait 6 years and it's gone, and then we'll look at it. So there will be circumstances where people have not gone to a broker, which is absolutely fine, but they've gone direct to a lender. That lender just happens to be one of the lenders who isn't willing to take a view on something like that, and they're then told you can't get a mortgage. And I'm sure there are then people who go, I can't get a mortgage.
Yeah, well, you might remember a conversation that we had probably 4 or 5 years ago where I was buying, it was a buy-to-let with a chap, and he had multiple properties, good cash deposits, and he'd sold his business. Yeah. And when he sold his business, the chunk of money had gone in his bank account, but cash flow monthlies weren't coming in. Yeah. And for a short period of time, he had a conversation with his lender. That lender had said to him, "It's not a problem, Mr. Owner. We'll give you a holiday." Now he thought, brilliant. Yeah. Whether they did or whether they didn't explain the terms to him or whether he didn't read the terms, I don't know. But I remember us applying for a buy-to-let mortgage and getting a call from the advisor to go, "Sorry guys, but your mortgage is being turned down." And we're looking at each other going, "What? Yeah. Why?" Yeah. And it transpired that the lender that he had paid the mortgage off in question, and that lender had held a report on his file which said, Mr. Owner of property missed or had a holiday on his payment. Now, in the end, the way we would have got around that is that we could have taken him off the application, put just an individual on the application, and they'd have lent to us. But together, they weren't interested. Yeah. And, I find that incredibly frustrating that lenders out there would allow someone to try and help them, but then put a black mark on their name for a period of time because they were trying to help, not because he necessarily couldn't afford to make the payment. And are there rules and regulations out there where they should be being pretty clear on?
They should definitely be explaining exactly what it is and what the impact of having a payment holiday. And this was
before COVID.
I can remember.
Holidays in COVID were kind of the norm, weren't they, for many people? Yeah. But this wasn't before that.
I think personally, for me, anything, any sort of arrangement with a lender that is outside of your contractual arrangement, unless you are making a change, changing the term or something like that, I would be very, very wary of and just make sure you speak to someone outside of that firm before you do it, because that's a perfect example of where someone thinks that they're doing something that isn't going to cause any major issues, and in reality shouldn't, because there's a story behind it, but it does. And unfortunately, you can't undo the past. So once it's done, it's kind of.
I remember him saying to me, had I known.
Yeah.
Never done
it.
Had I used other available cash.
Absolutely.
It was just I thought that they were trying to help.
It's the same with, which always baffles me why certain lenders will not look at the example of a utility company putting a £20 default. Do you really think that if someone knew they were going to stick a default on you would not pay a £20 bill? The reality is, of course you would. Of course, it's different if it's £5,000 or whatever it may be, but those small ones that can cause an issue, they are frustrating, but I suppose the answer is you can still get a mortgage.
Do you find that there's a bit more of a specific lender that will look at those with worse credit?
So there is, there's well-known lenders on the mainstream lenders that have sort of mainstream rates that are more lenient with their credit profiling. If you're in the industry, you know exactly who they are. But, it goes back to, if you go to a bank direct, they will have their one set of credit profiling, and you'll either meet it or you might not meet it. Yeah. Whereas if you approach a broker who looks at sort of whole of market deals and can look at, a variety of mainstream lenders, they'll sort of know, they'll have a good gauge. And if you do have a credit blip, if you have, £25 default or something, then there are a handful of lenders mainstream that will discount sort of mobile phone communication defaults or utility defaults under a certain limit. So there are options there. It's just educating people to know that there are options there.
And on the other end of that then, someone who, has sadly come into financial hardship in a big way, clearly there's going to be a period of time that they're going to have to rebuild and get themselves in a position where they can buy another property. That's not going to happen necessarily overnight. But what are they going to have to do in years to come, let's say 5-10 years time? What are they going to have to do to prove to a lender that, yes, they've had a mishap in their finances over years, whether that be due to a business, whether that be just things out of their control or even in their control? Are you saying to us that, if I've gone bankrupt, I'm never getting another mortgage, or are we saying mainstream might stay away from us and there might be some specialist lenders?
Yeah, time's a big healer with credit, and most lenders are really looking at the last 6 years. So after 6 years, a lot of things are going to drop off and not cause as much of an issue or any issue at all. I think the other thing as well, it comes back to the story and the plausibility. I have seen it where people have had really, not great credit, but there's been a reason, a life event. I don't know, maybe they've got cancer and had to have 2 years off work. During that time, they've had to rely on credit. And in that instance, for some lenders, if they can, take time to understand the story, they get, this is where we were, this is what's happened, and this is where we're going. Some lenders will take a view on it. So, I think with any of those situations, you need to just speak to someone and lay it out. We're not going to be able to solve every problem. For some people, the answer will just be, you're just going to have to wait. Yeah. But for most people, you can normally find a... Yeah.
I think it maybe falls quite nicely into something that just popped into my head, which was more on the self-employed basis. That we've, off camera, we've spoken about this on a number of occasions, and the situations that we've had to customers ours, or even individually, where you had a mortgage with a lender. Yeah. That lender was quite happy to lend to you as an employed individual on X amount of money with a X amount deposit, and then all of a sudden your situation changes, that you have become self-employed, and your earning capacity then may go up, but there's been so many circumstances, and not just individually, but across my years in the industry, where lenders have then gone, no, I don't want to know about you anymore, and the gentleman or the lady's gone from earning capacity here to earning capacity here. So actually their finances are in a far better state, but because they don't have that lovely tax return of 1, 2 or 3 years behind them, that lender's gone, no, I'm not interested. I think my biggest frustration is that individual could go, I can't get a mortgage now, so I can't move. And from us as agents' point of view, they then don't ring the agent to get them out, because their current lender has gone no, and they think because one lender says no, that they're not going to get another lender. And I say no from personal experience, that there's that disheartening moment when you think, I'm stuck where I am right now, and I need to move for life reasons.
It knocks the market.
Absolutely.
About it.
But I guess the question I'm asking to you guys is if someone that's watching this finds himself in that situation, what are the options?
Which we've all been in.
Yeah. So, I mean, lenders are not shying away from lending to self-employed people. You know, there seems to be sort of a myth or a historic myth that it's really hard to get a mortgage if you're self-employed.
Yeah.
If you are newly self-employed, potentially, because what lenders go off, like you said, Ollie, is a track record. So they'll want to see 1, 2, 3 years of tax returns or tax calculations. And it does depend on if you're a limited company, if you're a sole trader, if you're in a partnership, the percentage of shares that you own within that limited company, how that lender will assess your income. Realistically speaking, you know, if you have gone from a permanently employed role to a, you know, sole trader or 50%, 100% limited company director, you will need at least 1 year's of accounts or 1 year's tax calculations. There are a couple of lenders on the market that will look at potentially lending after just 1 year you have been self-employed.
Okay.
However, the majority will take an average of 2 years or need 3 years books. And that is what we see. But again, it's just knowing your options when you're self-employed. They may pick the phone up to their existing lender, and that lender might say, right, we need 3 years of accounts and we'll take an average of the last 2 years. However, they may speak to a broker, a whole of market broker or an advisor, and go, yeah, we've got someone who'll actually do 1 year's of accounts. And if their income has increased since being permanently employed, then they might be able to, you know, they might be able to borrow what they need to borrow.
I do have some sympathy with lenders on self-employed because it is very backwards looking.
Yeah.
You know, they don't have any way of knowing what you're going to earn. So you could have a situation where someone is having the worst year of their life business-wise, but the last 2 years were really good, and they won't have any issue borrowing money. And you could have the reverse situation, and they're going to struggle. So it is difficult.
But I think the employed situation is only a vehicle, isn't it?
Yeah,
you know,
yeah.
Ultimately, you might have Mr. A, who they've had in their industry, they've had 2 brilliant years, they've earned big commissions, they've earned big bonuses, and then for whatever reason, the owner of the business become unwell, and then all of a sudden the business no doubt. But actually, the lender's looking at it that John's earning X amount a year, and he's earning it 2 years, and doesn't actually then go and look at you know Steve Smith, the mortgage lender, whose lads have been doing really really well. And then go, oh yeah, but the business isn't doing it. They're purely looking at the individual. And when it comes to self-employed, you know, as most of us sat around here are, they're looking at you really deeply as an individual and as a business. But when it comes to you as an employed member of staff, they're not doing that. So it frustrates me massively because why don't they look at, you know, I know they're not going to be able to go to Sky, if you're working for Sky, and say, let me see a set of your accounts, because they're going to say, no chance. But, you know, you see the point I'm coming to.
Yeah, absolutely. Yeah, and it is definitely a frustration, without a doubt. It's just one of those, I think with self-employed, the best advice I can give to self-employed people is speak to a broker and find out exactly where you stand, because unlike someone who's employed and, you know, on a salary, you could roughly say, well, times your gross income by 4.5, and that's going to be kind of there or thereabouts. With self-employed, it just completely depends, because some lenders, as Graham said, are going to go and look at tax calculations, tax year overviews for the last 2 years. So they'll look at your salary and dividends. Others will look at the latest year's salary and dividends. Others will look at salary plus your share of net profit. So there's so many different ways you could do it. And you can definitely have scenarios, and there's a kind of a common theme here with mortgages that, you know, one man's trash is another man's treasure. So you can have scenarios where you go to a lender and they say, you know, yeah, we could do it. We could lend you 100 grand. The very same person with the same accounts could go to another lender and they could say, yeah, we could do it. We can do 200 grand.
Yeah.
You know, you do sometimes see those big disparities just because each lender has their own different way of looking at things.
Do you find it takes the lender a longer period of time to actually come to a decision whether they're going to lend or not if they are self-employed to somebody that is employed?
I think...
Do you find that?
It depends on the business and how it's set up.
Sure.
If it's straightforward and they're looking at, you know, salary and dividends for the last 2 years, they kind of would just treat that as an employed case. It would just kind of go through, wouldn't really be any issue. If it's, you know, a bit more complicated and you're looking at latest years or things like that, then, you know, they might start to ask more questions. During COVID, there was a definite uptick, wasn't there, in terms of what they were looking at. So they were asking for business bank statements. They wanted to know about COVID bounce back loans, how it was trading, etc. And it got to the point where they were almost like selective of the industry type. Right. So if you said, I'm a self-employed DJ, they're probably not going to want to do that during COVID. So,
yeah.
But generally, day to day, they're looking at the figures. If the figures stack up, sometimes there might be a bit of a plausibility question.
Do you think there's going to have to be some kind of review on the self-employed model self-employed mortgage world, because clearly COVID's affected that massively, hasn't it? There's so many more people who have gone self-employed and decided to break off on their own. So I don't know what the percentages are, you might know, but surely the proportion of employed mortgages over self-employed mortgages, we're in favour of employed mortgages, but surely there must be a movement that's been made due to so many people going self-employed.
We see loads of self-employed, but that's kind of anecdotal, and I think if you're self-employed, you're more likely to go to a broker because you know it's going to be complicated. So difficult to to comment on that exactly. But
I think lenders have, if you look at track record of how they've assessed self-employed people, if there was going to be some massive change, it'd have potentially happened by now.
Right.
Whereas I think they will potentially continue to look at how they do it, whether that's from tax calculations, share net profit accounts.
Yeah.
There's no other way of demonstrating it. I mean, just one misconception that we come across a lot is people who have a limited company, who are a director of that limited company, and they say I have a share over 20% or 33%, and for 3 months they will up their salary, or they'll say, I've had a salary increase 6 months ago, and they've started paying themselves 70,000 instead of 20,000, and they'll think because they are employed by that limited company, they'll be classed as employed and they'll be able to use that income. Right. However, because they are usually with lenders, it's over 20%. If you own 20% or more of a limited company, you are still self-employed. So they will still look at tax returns and accounts. They won't take those pay slips. So you get a lot of people thinking, I'll up my salary, and in a year's time I'll look at moving, or in 6 months' time I'll be able to borrow this amount.
So would that affect someone then who was, let's say they were a director of a firm and they had 25, 30, 40%, but actually weren't actively working in that business?
Yeah. That
could affect them.
Yeah, so they could use dividends in that instance for affordability rather than...